Hello everyone, welcome to today's weekly market insights. Now, as we have a look across to the calendar, pretty quiet economic calendar in terms of macroeconomic numbers for us to go off. But a couple of things we did have was the minutes out of the RBA. Not a great deal out of this, as we did see their hawkish tilt at their last meeting when they removed their patient pledge from their statement. The pledge to remain patient in regards to raising of interest rates. They want to see wage growth sustainably higher before they go hiking interest rates. Initially, they had stuck to the script that they were going to hike interest rates in 2024. They have had to then wind that back in previous months due to the sustained levels of inflation across the board in the respective economies. So they seem more willing to hike interest rates quicker than anticipated, and market participants seem to believe that at some point throughout this summer we will get an interest rate hike from the RBA. That hawkish stance is backed up by the GDP of China that we had out 3 a.m. Monday morning. Came in 4.8% for Q1 over this year, for the year-over-year figure. Previous figure was 4%, so an increase on the last one. Both above consensus and forecast, whatever way you choose to look at it. A positive number all the same when the Chinese economy grows, when the Chinese economy strengthens, because the Australia, their biggest trading partner is China. When China do well, Australia also do well with them, or can also do well with them. And when China do badly, Australia also is under a bit of pressure along with that as well. So strong growth in China, bounce back in some of the numbers in China that have been low for some time, is also a positive for Australia, and also has to play into the RBA's thinking. And we come around to inflation then out of inflation out of Canada on Wednesday. Probably the main focus of attention in relation to the calendar throughout this week. Inflation out of Canada has reached the highest level since 1991. We can see here the actual figure, 6.7%. Previous was 5.7%, so an increase of 1% in the space of a month on the year-over-year figure. So inflation still rampant in Canada. We did have a 50 basis point rate hike from them at their last meeting. And they are one of the leaders in the G8, G10 space in terms of hiking interest rates. So they were the first to wind back their monetary stimulus. They were one of the first to hike interest rates. And they are now one of the most hawkish central banks that there is in the G10 space. So that fuels that fire. That adds fuel to the fire. You know, if they're on a hiking cycle and inflation is continuing to grow, then they're just going to have to hike further, aren't they? Which, yeah, as we come across to some charts and have a look at what's going on, we can see probably the main focus of attention this week is the dollar. We can see we have looked the Australian dollar against the US dollar, Aussie as I like to call it. We are still moving lower across this. Now, if we're expecting a hawkish RBA, if we're not expecting, if you had a hawkish RBA, you would expect this to move higher. But this just shows that the US dollar is the dominant currency, and the US dollar does what it wants. If the US dollar wants to go higher, it will go higher. It will push most currencies across the board. It will push them lower against the dollar. Likewise, on the flip side, if the dollar goes lower, it should push the rest of the currencies higher against that. So that's where our technicals come into play. Have our analysis of markets. We can see we are clearly technically still in a downtrend, printing lower highs and lower lows, broken through this. Oops, it's a bit of a dodgy line, broken through that, creating a new lower low, signaling trend continuation. So got to be a little bit careful of that. We can have our opinions on the fundamentals and stuff, but if this is still trending lower, it is probably wise to sit on the sidelines for now. We don't want to see this to turn around, show some indication we could turn around. First port of call on the downside, if we could get down towards there, something down there would probably be worth taking a look at anyway, in my opinion. Reason being, I would probably expect to see some dollar downside coming through. We can see the US 10-year yield, the massacre across bonds continues. We are up now 3%. We have had another positive week in terms of the US 10-year yield. Makes the dollar more attractive from a yield perspective. We can see here, if we blow up this chart, this is a comparison then of the US dollar and the US 10-year yield. So on the daily time frame, you can see back here since July of last year, how closely the US dollar has tracked that US 10-year yield. So the higher that US 10-year yield goes, the more support it's likely to lend to the dollar. Even if a lot of the hawkishness is priced into the dollar, in my opinion, I would expect to see some sort of a pullback at some point in the dollar, probably a broad-based pullback, judging by how far this has gone and how much hawkishness must be priced into markets. So remains to be seen how that plays out going forward. But if this US 10-year yield continues to march on higher, if we get above 3%, as you can see here at 2.9, we can get above 3% here, that is likely to get the dollar above 101. We're stalling. If I just hide that back up, we can see US dollar up at 101 at the round number. Rejecting it for now. If the 10-year yield breaches 3%, this should then breach 101, and that should make for more dollar upside. Again, I would like to see dollar downside coming through within the next couple of weeks, but I've got to wait till the charts tell us. In terms of the weekend, in terms of the French presidential election, I've got the CAC around the French stock market up pretty range bound and sideways for the past since March, middle of March. So past month been pretty range bound sideways since Russia and Ukraine stopped affecting this as an indice. It does largely track the DAX. The DAX is kind of the leader, the European benchmark, but you've also got the euro as well to factor into what comes out of the French presidential election. The final round of voting is on Sunday of this weekend, so we should get a little bit more clarity of who we are expecting in due course, and that would be a big deal for markets. I mean, Emmanuel Macron with his policies is largely seen as a euro positive. He is seen as a CAC around positive, as a European stock market positive, because of his policies of he wants to increase employment. He wants to raise the retirement age from 62 to 65 to keep people in work for longer. Wants to raise the employment rate, get more people into work, and to try grow the economy organically. And then it's the classic example of probably standard politician to kind of right wing, where you've got Marine Le Pen on the other side of things, who's promising tax cuts, income tax cuts to under 30s. But how then the economy is going to be funded after that is obviously a bit tricky to wrap your head around. You can't just cut all these taxes and then just print money to deal with that. That has its own implications as well. So it's sort of a bit similar in my country. One kind of says it how it is, and it's probably not good for your average Joe, and then the other side make all these promises that cannot really be kept. So we'll have to see how that plays out. If Marine Le Pen was to win, markets are viewing it as a Brexit kind of thing. That I think she wants French independence, would want to leave the EU, and that would have widespread implications across the European economy. Macron, is largely seen as would be positive for Europe, positive for European related assets. So I think we could get some movement either way, when we get some clarity around that event at the weekend. As we come across the next week, look forward to next week. We have a couple of data points out next week. We have inflation out of Australia. With the hawkish tilt from the RBA at their last meeting, we would look for some inflation strength. Now, the difference between the Australian inflation is that it is once every quarter. You get 4 inflation rates a year out of Australia, so that is something we definitely need to pay attention to. They don't come around once every month, once every quarter. So this is the figure for Q1. This figure for Q1. So previous is 3.5%, consensus for 4.6. If we got above that, I would not be at all surprised, as you've got the whole first 3 quarters of this year to take into consideration, and not just the last month like the rest of them. Apart from that, we've got inflation out of Germany on Thursday. We've also got inflation out of the Eurozone on Friday. I think those figures will be important, as last week we had deflation figures out of the US. Markets seem to view that as a topping out of inflation. There was a little bit of a failed to print new highs on the core inflation rate when we've seen at the last US figures. So I think these figures will be looked at quite intently. If we do not get I mean, consensus and forecast for the European inflation rate is not that much past the previous rate. If we do not beat that, or even if we have a miss, and that shows the potential topping out of inflation, as these central banks have predicted, that would be, that would have widespread implications across all of the central banks thinking. If inflation started to cool down already, we can't really make too many assumptions on that. We do need the figures out to make our decisions based off of that. Apart from that, it looks like a lot of data here, but it's just GDP figures across each of the economies across Europe. Do have US GDP on Thursday of next week, which we will also keep a close eye on. But yeah, then I think main focus of attention coming into next week is that 3% level on the US 10-year yield. Is that 101 level on the dollar index? Do we get a pullback, or do we get a continuation? I think we'll need a break above both of those. Well, I don't think we will need a break above all of those levels in order for us to have confidence and conviction of this move continuing higher. And then whatever happens in France will happen, and it will be up to us to try and take some cash out of whatever move presents itself. So apart from that, keep your eyes peeled. US dollar 101, dollar index 101, 10-year yield in the US 3%, and the French presidential election, where Emmanuel Macron is currently up in the polls as much as 56 to 44 across some people's opinions, some people's polls. So remains to be seen how that goes going forward, but they're not a million miles away, and they are expecting a close battle at the weekend. So anyways, that's it from me then, folks. Have a good evening, have a good weekend. Do get some rest and relaxation, and if you can, ready for another week of trading next week. That is all from us for this week, and please do join us next week for another weekly market insights. Thank you.